Okay, let's continue our discussion on liabilities. We left off showing the financial statements for year two. Here we have the income statement showing the sales revenue, less cost of goods sold to get our gross margin, minus the warranty expense to show a net income of $2,900. The balance sheet shows our current assets, cash, and inventory, total of $10,960. We still have a warranty payable liability remaining for $60. We have common stock of 5,000, retained earnings of 5,900. Therefore, the assets equals the liabilities plus stockholders' equity. On the statement of cash flow, there was 7,000 that came in from customers. We spent $40 on the warranty expense. The net cash inflow was 6,960. At our beginning cash balance, get the ending cash balance of $8,960. We're going to now switch from current liabilities to long-term debt. Okay, so with a long-term debt, these obligations will become due in a time frame longer than 1 year. Most of the time, long-term debt has a fixed interest rate, such as your car note or your mortgage payment. It has a fixed interest rate. But sometimes long-term debt can have a variable interest rate. So if you have a mortgage with a variable interest rate, it means the interest rate will fluctuate. It could go up, it could go down. It is not at a set amount. So we'll focus on how to account for long-term debt at a fixed interest rate for the most part, but we can also talk about how to account for long-term debt with a variable interest rate. Now, when you make your mortgage payment and or your car note payment, a portion of that payment goes to the principal amount to reduce the amount owed, and a portion goes to what's known as interest. That's called loan amortization. So I'm curious, when you make your current mortgage payment or your car note payment, do you know what portion of that payment is for interest and what portion goes to the principal? If not, that's something that you need to know and we'll learn how to do in this chapter. We'll first look at how to account for what we call installment notes. Installment notes. So an installment note is a note that requires payment of principal and interest at regular intervals. Those are known as installment notes. The term of installment note normally range from 2 to 5 years. For example, let's assume that Blair Company borrowed from the bank $100,000 on the 1st of January, year one. Blair issued the bank a 5-year installment note with a 9% fixed interest rate, meaning that this note will be paid back on an annual basis over a 5-year period. When we first borrowed the money, this is for the books of Blair, you will show an increase in cash for $100,000. The notes payable account will increase by $100,000. On the statement of cash flow, $100,000 increase or inflow from a financing activity. Now, to repay that loan, they're going to pay 5 equal payments of $25,709 each year. So remember, we borrowed $100,000, but you're paying back $25,709 each year over a 5-year period. Let's see what portion of this payment will go to the principal amount, what portion will be applied toward the interest. Okay? So you want to first always determine the interest portion of the payment first. Remember, interest equals principal times rate times time. Again, principal times rate times time. The principal amount is $100,000. The interest rate is 9%. You're making an annual payment. Therefore, $9,000 will be the interest amount in year one. So now subtract the interest portion from the amount paid, and the remaining balance goes toward the principal to reduce the amount owed on that loan. That amount would be $16,709. Okay? Subtract that from the amount borrowed, $100,000. The remaining principal balance is now $83,291. Now that's good because now you have a smaller principal amount. You will pay less in interest. So for year two, you're taking 83,291 times 9% to get the amount of interest. You're still paying the same amount, 25,709, but notice now a larger portion of your payment goes toward the principal because you've reduced your principal balance. And we'll follow these same steps all 5 years so that by the end of year five, notice that you've paid off the entire loan, by the end of year five. So this is called an amortization schedule, where it is showing what portion of your payment will be interest, what portion of your payment will reduce the principal. You can do the same thing for your car note, for your mortgage, to show what portion of your payment goes toward the principal amount, what portion goes toward the interest. Okay, so this is for that first year. On our balance sheet, cash would decrease 25,709. The notes payable account decreased 16,709. Retained earnings decreased 9,000 because that was your interest expense. Now notice you paid 25,709. That payment is divided up on the statement of cash flow. 9,000 is an outflow as operating activity. That's the interest. The 6709 is the outflow as a financing activity. That's the amount that was paid against the principal balance. Okay? So here we just see the statements for all 5 years. Note the interest expense is going to go down each year. The part that I forgot to mention is that we used that money to purchase a product that was earning revenue 12,000 per year. So 12. So here we see the revenue each year, the interest expense, and this is the net income from year one to year five. Notice that on the balance sheet, the notes payable account is decreasing. By the end of year five, you paid the loan off in full, and we do not have a remaining balance on that actual note. On the statement of cash flow, again, you're paying the same amount, 25,709 each year, but this is showing the inflow of cash from customers. This is showing the interest expense. This is showing the portion of the payment reducing that principal balance. If you add the 9,000 to 6,709, this number, it's going to show you the total payment, but it is showing what portion of the payment goes to the principal balance, what portion of the payment is going to be shown as interest expense. Okay? Next up, we focus on what's known as a line of credit and how does that affect your financial statement. Well, a line of credit enables a company to borrow or repay funds as needed. Credit agreements usually specify a limit on the amount that can be borrowed. So, for example, if you own a house, you might put a line of credit on your house if you have equity in your property. The line may say you can borrow up to $100,000. So it means that you can use that line to borrow money, but as you borrow funds, you will pay the money back according to the actual terms of that agreement. So this short is showing pretty much there's going to be disclosing credit agreement 90%, showing the agreement for a line of credit. Non-disclosing credit agreement is only 10%. So if a company has a line of credit, a credit agreement, 90% of those line of credit, that information will be disclosed. as part of their company annual report. There's a small percent of those companies that do not disclose the terms of their credit agreements as part of their annual reports. Now, typically, when a line of credit, the interest rate is not going to be fixed. Most of the time, it is going to be called a variable interest rate. It is going to fluctuate, okay? Such as the rates paid on U.S. Treasury bills, something called the prime interest rate that's set by the government. So when you have a line of credit, understand that the interest rate most of the time will be a variable rate, meaning that the interest rate is going to fluctuate on that line of credit. Okay, so here's an example. Lagoon Company borrows money to use a line of credit to finance build up its inventory. So we use our line of credit to buy inventory. We repay the loan over the summer using cash generated from sales. So here we borrowed $20,000 in March. The interest rate was 9%, so the interest would be $150. Then in April we borrowed another $30,000. So now we owe a total of $50,000. Interest rate still 9%. The amount of interest for the month of April will be $375. But now notice in March we borrowed 50 more thousand. We owe $100,000, but the interest rate changed to 10.5% because it is not uncommon to have a fluctuating interest rate on line of credit. Interest now will be $875. We're now starting to pay back the loan in June. We paid back $10,000. You still owe $90,000. Interest rate is now 10%, so we paid $750. In July, we paid back $40,000. Now you owe $50,000. The rate back down to 9%. You paid $375. In August, we paid off the full loan. Therefore, no interest expense was recognized for the month of August. So a line of credit is used to as a resource to finance things such as buying inventory, but it has a variable interest rate. This is just showing a summary of all those transactions on the balance sheet, the income statement, as well as your statement of cash flows. Okay? We'll now look at a new type of debt known as bond liabilities. Most of the time, we look at bonds as an asset. We look at bonds for savings. And that's true if you're buying a bond. But if you're issuing a bond, you now have what's called a bond liability. So when companies need to borrow money from the public, they issue a bond certificate, which allows them to receive funds from the public that they're going to pay back at a later date. So there's two parties, the bond issuer, the bond holder. If you purchase a bond as an investment, you are the bond holder. For you, that's an asset. But if you're issuing a bond, then for you, that's known as a liability. Okay? So most bonds will have what's called a stated interest rate, meaning that this is the interest rate that the bond issuer is going to pay to the bond holder over the life of that bond. So if that bond has a 5-year maturity period, you're going to pay interest to the bond holder over that 5-year interest period. Okay? So here we have a sample of a bond. So it shows the bond's face value, which is $1,000. It will have information as to when does the bond mature, what is the interest rate on the bond, etc. Okay? Now, this is more old school. Bonds now can be purchased online using other resources such as Charles Schwab, Robinhood, and Ameritrade. So you may not really see this actual bond certificate because now a lot of bonds are purchased online using some type of investment firm. Okay, so we're going to talk about how to account for the issuance of bonds. What does it mean when it says bonds have been issued at their face value? Stay tuned for our next video lecture on Chapter 7.